I don't want the founder to be focused on like tomorrow's goal. I want them to be focused on 10 years from now, or at least 3 years from now. The North Star has to be there. I want the founders, and this is my personal thing, I want them to be like extremely resilient. This is, I think, a very important characteristic. And that's a broad term. And I think it also encompasses, hardworking and all of this. So I want guys and girls, obviously, that are like tenacious, resilient, and react, not like laid back and kind of cruisy. Something happens, react, like cut costs, fire 20% of the people, don't care, we're going to survive, we're going to get more money. When you invest money in marketing and getting new clients, that money is invested properly. But it's really like a metric for repeating businesses and B2B SaaS. Other businesses don't necessarily have that metric. To me, it's not just the metric, it's understanding the scalability of a business, whatever that business is. It might be a hospitality business that isn't necessarily lending itself to LTV to CAC calculation. Okay, what is the right calculation for that business? Like, how do you ensure that that business can scale profitably? Maybe it's a different metric. And so it's not sort of like, well, here's the things you got to figure out. It's a more fundamental question about scalability and fundamental profitability of a business.
Hey, Dennis, welcome to the show. How are you doing today?
Good. Thanks for having me. How are you?
I'm doing great. I had Anton on the podcast already. So we talked about Flashpoint. We talked about all the amazing stuff that he's doing and all the amazing stuff that, they're investing in. I want to focus today's interview primarily towards venture debt, growth debt, all of that stuff. Okay. It's going to sound a little bit nuanced, but I try to make it as easy for the audience to understand as possible. Okay.
Sounds good. Let's do it.
Okay, awesome. So everybody that I have on the podcast, I start us off with just one point, which is the context of your life. What is your story? How did you end up at Flashpoint? How did you end up becoming a VC of all things?
Okay. Well, look, as you mentioned, by trade or by training, I am actually an actuary. So I started off my career a long time ago, mind you, and I'm dating myself a little bit. A long time ago, back in Australia, I started off as an actuary. I thought that was, a profession that played to my strengths. I liked maths. I like statistics, I like numbers. I like to kind of work with numbers. Sometimes more than working with people, and then they pay well. So I thought, okay, this kind of ticks all boxes. Why don't I do this? And that was good, I think, for 2 or 3 years. And I worked for good companies, and that was fun. But it's quite a limited sort of job in a way. You learn, there's a steep learning curve, and then you kind of learn most of the things, and then it becomes a little bit less exciting. And this was like mid 2000s. So this is pre GFC. All my friends were joining investment banks and making like 3 times more money than I was. And I thought, all right, this is like, why don't I do this instead? And so I started looking for a job, either in investment banking or in private equity. And I got a job with Macquarie Bank, which is Australia's kind of main bank. They do a lot of infrastructure investing. And I joined them in January 2008. All right, I managed to stay alive during that year. But that really was the start of my career in I would say, private markets and in investing. So this is not VC, but it's private equity. And I've done that for almost 15 years. I was there for a long time. But then, at some point, you as well, but generally some people want to do things that are a little bit more entrepreneurial. You sometimes get frustrated at being part of a corporate machine, like doing political things rather than kind of what you think is the right thing. And an opportunity came up to join Flashpoint because I know one of the founders very well. We go, back a long way, over a decade, since before Flashpoint. And he needed somebody to help him with the venture debt or the growth debt product, which they launched sort of about a year ago. And they just needed to strengthen the team. And I thought, okay, this is an opportunity to do something that's a little bit more entrepreneurial. So it's not kind of your corporate job, which is very comfortable and all of that. But this is a little bit more, as my former boss used to say, this, put some hair on your chest. It's a little more risky. But more exciting. You get to build something. And that's how I became, part of Flashpoint's venture debt team, which I head up at the moment.
Okay, awesome. Thank you for sharing that. So let's start with what exactly is a venture debt, but most importantly, why venture debt exists?
Well, sure. I mean, venture debt exists why it exists, I would say, it's the same answer as to why any debt exists. It's a form of capital that's in a different risk spectrum, a risk return spectrum to equity. The only question is, at different stages of a company's lifetime, is debt available to the company? because debt assumes a certain amount of risk, which is lower risk. It's a lower risk exposure to the company. And therefore, if a company is at the very beginning of its life cycle, then debt is just not available to it. It needs to have a certain level of maturity. But once it's reached a certain level of maturity, then debt becomes a viable instrument, and therefore it exists because it's available to it. And it should always be part of a capital structure, because if you think about how you fund the company, your goal is to take the cheapest possible capital and optimize the cost of capital for your company. And debt is cheaper than equity, right? So you'd always take some debt if you can. And so venture debt is effectively, it's a senior secured amortizing loan to companies that are largely, and for the most part, VC backed. So they're companies that are still going through a growth phase. They're scaling. They're not profitable in most cases, but and therefore, because they're not profitable, they're not bankable. But at the same time, they have VC support, and they have enough substance and revenue to make them creditable from our perspective. And the loans that we provide to these companies is we call them growth debt.
Awesome. So two-part questions on that. So one is, what stage usually you comes in? Like, is it post Series A, close to IPO, early stage? So that is one. And two is, while you're answering this thing, so you mentioned like most of these companies are not profitable. Do VCs actually care about profitability? Is that a thing?
Let me maybe answer the second part first. Do VCs care about profitability? I think everybody should care about profitability at the right time, right? So the purpose of making a business is to make money. It's not to lose money and just grow endlessly while losing money. You have to have a path. It's great to grow and take advantage of that opportunity whilst you can and whilst it makes sense. But you got to understand that eventually, like even Amazon, became profitable. So eventually everybody becomes profitable. And you need to keep that in mind, that it's not just a journey of growth forever. You need to have growth, with profitability at the end of it finally in mind. That's sort of the first thing. And so, VCs, care about value and creating value. And for the first part of a company's lifetime, or for some part of a company's lifetime, creation of that value means that you have to be loss-making. And that's perfectly fine, because if you don't care about growth, then you'll never get anywhere. You're never going to go beyond like a 1 million revenue company if you just grow 20% a year. Like you have to go through that period. In terms of when venture debt becomes kind of possible, and this is my personal view, and I guess how I think about it at Flashpoint, and I guess different lenders might think about it differently. But the way I think about it is that we fund a very specific thing. We don't just fund the company in a sense. We fund a specific risk and a specific activity that the company does, and that's scaling, right? It's executing on something that's already working. It's not like developing a new product. It's not necessarily going to a new market. It's really, the company saying, I've got a great product, the market is buying it, look at my growth. I just need more money to get more clients. That's all I need, right? It's the scaling and execution of that scaling. That's what I'd like to fund. And so in order to fund that, I need to understand a few things about the company. And that's important to me. One, I need to see very clear product market fit. What does that mean in practice? Revenues and growth. So I want to see revenues of at least 5 million a year, and because you don't just want to see product market fit yesterday. You want to see kind of evidence of that. You want to see that ramping up. And so you need to see kind of a bit of history before you can lend. And so getting revenues around 5 million means that, maybe last year there were 2 million, maybe the year before there were, 1 million. And so having that ramp up gives me that confidence. And so that's typically what I look for. As I said before, growth is also important, because growth is evidence of product market fit, that there's demand, and you're really sort of ramping up to meet to supply for that demand. So that's the second thing. So you can always buy growth. And this is important, right? Like anybody can spend money on marketing and buy growth, because obviously, the more you spend, the more customers you're going to get. But it's important to understand, does it actually add fundamental value to you? If you spend $1,000 acquiring a customer, the customer makes one order for $100 and leaves. Okay, you've got revenue, and you can say, look at how I'm growing, but that growth is not accretive. And so the third thing I look for is unit economics, which means that the company understands that it's scaling profitably. So fundamentally, it is profitable. It's just temporarily unprofitable because of subscale size and spend on marketing, right? But if you strip those two things away, it makes money, right? So that's important. And the fourth thing is, while you continue to grow, you continue to raise money. You can't sort of assume that the company doesn't raise any more money, and then in 12 months when it runs out of money, that's kind of the end of its story. And so having VCs in the cap table with reserves gives me confidence that if I give it a loan, in 12, 18 months when it runs out of cash again, I can have confidence that it'll, even if it can't raise from a new VC, it's still got backers that will help it survive and keep going. So these are the kind of main things. There's a lot more kind of nuance within all of that. But I would say that that's the main thing. I mean, one other thing I should mention though is, and this is maybe kind of a feature of our product more than kind of a general market feature, is we tend to stay away from company, like we want to see a company that has a path to profitability if it needs it. It sort of goes back to a similar comment I made on unit economics, but I'll give an example. There are some companies that need to get to a very large scale, like, I don't know, like delivery, like Deliveroo or whatever. Like the margins are very thin. You need to really dominate that market, in order to become profitable and successful. And if you're at the early stage of that, like if things don't go well, like no matter how many costs you cut, you just can't survive. Like the margins are just not there for you, right? You need to really grow. You can't at some point in time kind of turtle, stay flat, survive and then go again. And so I don't like having to be in that position, because then you're the subject of market sentiment. You have another crash or whatever, and another 2022, the funding isn't there, and then you're kind of screwed, not because the company doesn't work, but because the money is just not there. And so I like to see companies that have bigger margins, that can cut costs and become break even, or at least reduce burn dramatically, if they really need to. And so that's another kind of safety measure for me.
Okay. So that potentially means that you'll be focusing on B2B SaaS and probably staying away from consumer products, CPG products, I think, right?
Yes and no. I mean, look, I love B2B SaaS. Everybody loves B2B SaaS. I'd love to just do B2B SaaS, because then I would have a much easier life. But unfortunately, there's not enough like B2B SaaS that's VC backed, that is getting debt to deploy 100 million into. I mean, maybe there is at a later stage, but not at the stage that we're at. So I look at any decent quality B2B SaaS opportunity that comes my way. Devil is always in the details, because a lot of things can be like B2B SaaS, but are they really? Do the economics work? Like, do you have like 2 big clients and that's it? And then you're kind of screwed if one of them happens to churn. So a lot of devil in the details, but I will look at anything that is like tech enabled or tech related. So, I won't look at a fireworks factory and, that's just not, it's got to be tech enabled. Because, and people ask sort of, why is it? Why do you look at any business? And it's really because tech is the only kind of segment that is suitable for venture investment because of the growth, right? Tech, is a field that facilitates rapid growth if done right and if you have a good idea. And that's why VCs look at tech. And for us, to fund a business, it's got to have VC backing. And therefore, if you look at a company outside of this without VC backing that's unprofitable, I just don't know where the funding comes from. Those companies tend not to grow very fast. They tend to become profitable very early, and they tend to go down a different route. So they get bank debt, or things like that very early in their life cycle. So tech-enabled or tech-related companies that are on kind of the VC path, they're within my universe. It doesn't have to be B2B SaaS. We can do consumer. The key thing for me is the unit economics. The 4 or 5 things I mentioned before. So that's really how I assess them.
One question that I really want to ask and understand, because of your intensive experience in economics and investment banking and in this finance world, how do you define unit economics? Like, what exactly is unit economics to you? Because a lot of people have, it's pretty much the same sort of a definition. It's just like, hey, there's a bit unit economics work, and nobody wants to kind of explain that, like, what the heck is that thing, and how do you find if that works or not?
Yeah, look, I mean, I guess the principle is, it's the economics of the most basic unit of the company's business to me, because the business, the way I look at it, consists of the unit economics, and then on top of that you have like scale, G&A, one-offs, and all other things that can happen to the company, right? But unit economics to me is the fundamental profitability and efficiency of a business or a product, right? And so to me, if you have to strip away all the temporary things that affect its P&L and look at basically for, is a dollar that you invest in the company buying you $3 or 50 cents of value? That's fundamentally what it is. And it's not just one metric, right? It's not like LTV to CAC is the most kind of useful metric, but there's also like capital efficiency and, how much revenue do you generate from the amount of capital you raise? There's other kind of metrics and that VCs use. But, I don't want to kind of attach myself to LTV to CAC because it doesn't work for all businesses. It's a very important metric, and you always have to make sure that when you invest money in marketing and getting new clients, that money is invested properly. But it's really like a metric for repeating businesses and B2B SaaS. Other businesses don't necessarily have that metric. To me, it's not just the metric. It's understanding the scalability of a business, whatever that business is. It might be a hospitality business that isn't necessarily lending itself to, an LTV to CAC calculation. Okay, what is the right calculation for that business? Like, how do you ensure that business can scale profitably? Maybe it's a different metric. And so it's not sort of like, well, here's the things you got to figure out. It's a more fundamental question about scalability and fundamental profitability of a business.
That makes sense. What do you have in terms of a fund thesis? Like, do you invest in certain geographics, certain founders? By the way, when I mentioned founders, this is a question that I meant to ask initially. What do you look for in a founders? Or do you care about the founding team? Or contrary to that, like because you're investing in companies that are doing like at least 5 million plus in revenue, does that even matter? Like, what the founding team looks like, or you're actually looking for a CEO that can actually make that company from 5 million to probably 100 million in revenue. So what would you prioritize and what do you look for?
Yeah, I mean, it's an interesting question. We've looked at both cases. Like, let me sort of do it in two parts. One is like, what do we look for, I guess, in founders / people that are fundamentally driving the business? And two is, is it a founder or a CEO? We looked at both, kind of looking at the second part first. We looked at both situations. We have a company or a couple of companies in our portfolio that are CEO kind of driven, where the founders are no longer active. And then we have, I guess, most of the companies in our portfolio are still led by founders. To me, it's less about like whether it's a founder or a CEO. It's more about the capability of this person and their incentive to drive the business, right? Early on in the company's life cycle, like the incentive is very different to like a CEO of a mature business, right? And so naturally, like founders having, 30 or 40% of a company or whatever they might have, is the incentive, right? And it's their business. And so they have an attachment to it and that works. And then they're incentivized to make it a success. On the other hand, a lot of founders are not natural CEOs. They're entrepreneurs, and so at some point you've got to kind of transition. And so there's kind of two sides of that coin. And so if you have a founder, you're like, well, how good are you at actually executing? If you have a CEO, it's more like, well, what is your incentive, right? Like, are you incentivized in the right way for this stage of the company? So this is a key thing for me. What do we look for in founders? I mean, look, it's a different question. There's like, I could list like 10 qualities that are good for a founder, but makes the whole thing meaningless. People talk about like vision and all of that. Like, important for the founder to think like big and low. Like, I don't want the founder to be focused on like tomorrow's goal. I want them to be focused on like 10 years from now, or at least 3 years from now. Like this, the North Star has to be there. I want the founders, and this is my personal thing, I want them to be like extremely resilient. This is, I think, a very important characteristic. And that's a broad term. And I think it also encompasses, hardworking in all of this. So I want guys that are like, and girls, obviously, that are like tenacious, resilient, and react, right? Not like laid back and kind of cruisy. Something happens, react, like cut costs, fire 20% of the people, don't care. We're going to survive. We're going to get more money, like, solve problems and move forward. I think this is a quality that, because I'm a debt investor, right? Like, I want them to be able to deal with the difficult situations well, not sort of kind of, be good in a bull market. I want them to be like the winners in the bear market and resilient and survive. So founders and companies that I find that, and I've seen this in my portfolio as well, like companies that have gone through a tough time, like, in COVID, a lot of companies had a tough time, that have found a way through that have reacted, survived, optimized, cut costs, became leaner, meaner, and better. They're flourishing. And that's a lesson that they'll learn forever, and they're going to be successful. So I really value situations where people have successfully pivoted. And again, there are a few companies in my portfolio that have done that or are in the process of doing that, and it's amazing. Like, it's amazing when somebody's hits a snag. A poor founder would fall over. The company would kind of get sold for for 10 cents on the dollar or whatever. But these people, they pivot, and it's hard, and then they convince people to support them, and then you see this going again. And I think that's amazing. That's an amazing quality, and that really kind of sets a good baseline for a personality of a founder. I want people that are also aggressive in a way. I guess it's all part of the same kind of thing. You've got to be fast, aggressive, resilient. This is what I really like in people and in founders as a personality type.
Yeah, that's good to know, because a lot of people would usually talk about the other side of the things, but it totally makes sense that you're focusing on people who are just like, if the shit hits the fan, they know how to take care of like whatever. So totally makes sense. Okay, so when you say you invest in startups as a debt, is it purely a debt instrument, or do you actually take a little bit of equity? Do you like to have a little bit of a presence on the cap table, or do you just like, no, like that's not my thing? How do you structure the deal? I think that's a better way to ask the same question.
Yeah. No, it's I should have covered this before. But we're not pure debt. I mean, we are primarily debt in the sense that my primary concern is capital preservation. So, like, for my LPs, my number one priority is not to lose their money, right? I don't want to be my job is not like a VC fund where, sometimes it's great, sometimes it's not, and that's just part of life. My job is like, you're going to get your money back, you're going to get a return. It's only a question of how much return you get, right? So fundamentally, we're debt, but every loan that we give has an equity kicker. So it's called a warrant, as I'm sure your listeners know, which is basically a call option on the company's shares. And it just means that we can, at today's price, we can buy shares in the company of a certain amount. And that amount is like 15% of the loan amount. So in terms of dilution, it's a much, if I give them equity, it's 100% dilution. If I give them debt, it's 15% dilution. So it's a much less dilutive instrument, but it's still, for us, it gives us a little bit of upside in case we do lend to a future, unicorn or a Google or something. It means that there's an extra benefit to the fund. Also, we and this maybe goes towards our strategy a bit, but we can talk about it separately. But we like to follow on. Like, from my perspective, like, doing a single deal with a company is great, but doing a deal and then topping up and then giving them more money, seeing them perform is much better, because, you spend one time doing due diligence, you spend one time doing the documents, you spend one time getting to know the company. It's a much easier decision to make to give the company another 5 million than to give the first 5 million, right? If it performs, obviously. So we like to do that. And for companies that we have high conviction in, and so, when we've had a relationship with them, we've got the loan, we see the management and see how that evolves. We can put in equity as well, but it's a much smaller amount. It's like 5% of our fund. So for every, $100 that we lend, we can put five of that as equity, but only to companies that we lend to. So not just equity. It's only to companies that we know, that we have in the portfolio, that we have conviction. And so all of that is the product, right? It's the debt, it's the warrant, it's a little bit of equity, and that's the kind of the combination.
So do you also co-invest with your, venture product, the actual equity product? Like, Anton, you guys, do you actually invest together, lead it out or something like that? Or you're not, like, totally separate?
Look, it's a good question. We don't. It's
Why don't?
Because there's a conflict of interest. Fundamentally, debt and equity in a scenario where the company is short on cash. I mean, let me take a step back, right? So having spent quite a long time in PE, just kind of basic corporate governance states that once the company is in distress or it's in danger of insolvency, the board's fiduciary duty, should prioritize its creditors rather than the equity, right? And so if you imagine in that situation, you have both, then you're on the opposite sides of the table. And all of a sudden, the board has to act in a different way. And so having debt and equity together from the same, not from the same fund, but from the same group, right? It's a little bit different if it's from the same fund because it's the same LPs. So you can't benefit one set of LPs and not the other, but that's okay. But if it's a different set of LPs, but it's one manager, one set of LPs will always say to the other set of LPs, how are you acting in my best interest? Why don't you screw those guys and do a better deal for me, right? That's a conflict that you can't really manage well, aside from having like Chinese walls and all of this. But nobody really believes this stuff anyway. Like even if it's like Merrill Lynch telling you they got Chinese walls, like there's still going to be a little bit of kind of canteen talk, about what's going on. So, and from personal experience, this is just a conflict that is very difficult to resolve. And so as a principle, we don't co-invest with the equity funds. We, if there's this particularly interesting deal that we think is amazing for both parties, we will go to our LPs and we will tell them, or LP panels that we have in our funds, and we will tell them, we'll explain to them, and we will ask for their view, right? So we will never sort of take that decision. I mean, you could make the case the other way, why it's a good idea. And I know that some lenders and some VC funds actually build a business model around that. They because you have you lend, it's a lower risk entry point. You get a lot of information. You kind of onboard the company. You have its financials. You know everything about them. You might be a board observer or whatever. And then the decision to invest equity is then very easy. It's much easier than investing equity in the first place, which is a high kind of risk entry point. And so you could make a business, I guess, in a similar way to what we do with our fund, by having a little bit of equity exposure, but like oversizing that and putting a different set of LPs behind it. But then you have that conflict, right? And so I personally don't think it's the right thing to do. Well, right or wrong is kind of the wrong way to put it. I think it's a long-term, not in the best interest of the firm thing to do, right? Or the LPs, because eventually somebody will be unhappy and you won't be able to explain it to manage it, and reputation will suffer.
Totally makes sense. You gave me so many talking points. All right. So I'm going to go like one by one. So let's start with the first one. How big the pool is, how big the fund is that you manage. What's the average check size that you write? And what's the DPI of the fund that you have in mind compared to the equity side of the business?
Yeah, so the fund, we're fundraising at the moment. So the fund size is not finally determined, but we're aiming for about $100 million dollars, and we're sort of close to halfway to that. And we're going to be fundraising for another 12 months or so. So that's we should be, we're in good shape to get to that target. The average check size is an interesting question because, like I said, I like to follow on, and so my preferred path is to give a smaller check first, and then follow on with a bigger check at the next point. And so I anticipate that some companies in my portfolio will just get one check, some will get two checks, and the average of all of that, might be 6 or 7 million. But half of it will be 3, half of it will be 10, 12, 15, something like this, right? And so we can do a check of as little as 2 million upfront. Anything less than that just means that the work is not it's not worth the legal fees and stuff like this. We could do up to like 10 million up front if we've got high conviction in a borrower, and anything in between.
Okay. And the DPI of the fund?
I want to give my investors, about 1.8 times their money at the end of the fund. So once everything is distributed, that's sort of my target, 1.8 to 2 times. It's obviously less than VC funds, but obviously with VC funds, there's a much broader range, right? If you think about it fundamentally, each loan, like it's not a secret what like the interest rates are on these loans. But if you give somebody a 3 or 4 year loan with an interest rate of like 13% or something, right, and it's amortizing, then on this loan your TVPI is going to be like 1.3. It's that's just kind of a law of that's just what it is.
Yeah.
So you add a bit of warrants on top of that, and you get to maybe 1.5, right? And then you add kind of reinvestment on top of that. So you recycle the money and you get to a bigger number. And then you've got to have the fund fees and costs come off that as well. And so at the end, you kind of left, unless you have an amazing warrant portfolio, like no venture debt fund, is going to give you much more than 2. And so my target is 1.8 to 2 times.
That's very
TVPI at
okay.
the end of the fund's life, right? And so during the fund's life, for the first 4 years, there'll be like a dividend yield of about 5%. So that's what we pay a dividend in the first 4 years of like 5% of what the people invest. And so in the first year, the DPI might be 0.05, then 0.1, 0.2 after that. From year 5, we give all the cash back that the fund receives, and then your kind of DVPI as sort of a metric of how much cash you've got back so far in your investment. It starts growing very rapidly. It goes to, we basically give the capital back, so we get to 1 times TVPI by end of year 6, and then 1.8 probably end of year 8 or year 9.
Another two-part question. So first is, do you take board seats? If no, why not? And the second part of that is, how you manage the deal flow, because from traditional VCs, I actually want to know like how traditional VCs get the deal flow, but also want to take your opinion on like how do you manage the deal flow?
Yeah, do you mean how we originate, or how do we manage the deal flow? Like how we triage it?
Like how do you get like a lot of these people? So for example, 10,000 people pitches to you in a year, and you pick like 10 of them. Like what are the sources of getting those 10,000 people?
Yeah, sure. So I'll answer that first, and then you'll have to remind me what the first part of the question was.
Okay.
On deal flow, so there's a few channels. One is just called, we get a lot of approaches by companies or by their advisors. That's one channel. We have a relationship with quite a lot of VCs, and so there's an ongoing dialogue with these VCs. And in some cases, it's as deep as, well, let's kind of look at your portfolio. What's raising debt, and then we kind of have visibility on that. That's a very good channel because by definition we then already know the VCs, and so we can kind of be clear about who's backing the company. We have our own, I would say, I'm not going to say AI, but our own kind of
please say AI.
AI driven data engine that automatically does all this shit. Sorry, I won't swear, but basically, like, there's a lot of data out there, right? In Dealer Room and Crunchbase and other databases, and it tells you rounds companies raise, the VC backing, and all of that. And you can obviously crunch all that data, and you can filter it, and you can give yourself a list of prospects. And so if there's anything that's particularly interesting, we actually reach out to them as well, just from kind of the data work that we do. And I guess fourth is there's advisors that we know, that specialize in a particular region, whether it's kind of DACH, Germany, or whether it's in Israel or something like that have a lot of visibility, or maybe it's the Nordics that have a lot of visibility about what's going on in that ecosystem. And we have relationships with them, and they come to us. And finally, we have scouts. So we have people that are somehow plugged into this ecosystem that know founders and companies and VCs. And we have, basically a contract with them that says, for each company you bring us that we end up, doing a deal with, you get paid something. So it's like a scouting network. All of that comes together. And, I think the first two I mentioned probably are the most important, which is, like, companies already know us, and so they come to us. And the quality of that has improved over the last few years as, like, our brand has gotten better. And also just the VC relationships and dealing directly with the VCs, which has the added benefit of, like, their de facto approval before we even start discussions. Do we take board seats? We take observer seats where we can. It's not market everywhere. In the US, it's more difficult. For us, it's a very important tool. I would say that it's less important when things are going fine, but when things don't go well, being on the board and being in the live discussion, and even steering the board if we can, is much better than getting like some sort of summary, afterwards from the founder. It's immeasurably better. And so our approach is to always be present at the board, even if it's not a full-time observer, at least when the runway is like less than 6 months. So as soon as your runway drops and the board is, concerned with finding new funding or whatever, or changing the business plan or extending the, reducing burn, extending the runway. Like, they want to be part of that discussion. Like, when things are going great, just like getting updates on operations, like less fussed about that.
Okay. Yeah, that makes sense. That makes sense. Okay. How difficult is it to raise a fund for a VC firm these days?
Not easy, man. I mean, it's not easy to raise any fund at the moment. I mean, it's like it's a simple, we had a period of free money for 2 years during COVID, where everybody raised, everybody who needed money got money, whether it's a fund or a company, or it goes through the system, like like a warm glass of mulled wine, and everybody's happy. And then the interest rates went up, and so money became more expensive, and there's less of it, and it's more scarce, and asset prices changed. Companies are changing their asset allocations, and so it's not just us. I mean, it's branded large institutional VCs like like the tigers of this world that are raising much less than they planned, right? We're a small business, and our brand is not as well known as those guys, and so for us it's twice as hard. So it's, at the moment, it's still difficult.
You think your AI driven platform thinks that it'll get better in 2024 or 2025?
I'm sorry, can you say that again?
Like, yeah, do you think that it will get better next year
in terms of fundraising?
Yeah,
look, it has to. The reason these like peaks and troughs exist is because there are events that happen, and it takes time for the market participants to adjust. Like if you're a massive asset manager, you have private equity, you have equities, you have fixed interest, all these things react and shift, and your allocation becomes unbalanced. You have to change things, and for those changes to work their way through the system, for these shocks that cause other shocks, and to get to a stable state, it just takes time. But eventually, like, what facilitates fundraising is stability. It's not like any particular economic metric, right? And so I think, sure, it's going to get easier over time in the absence of new kind of macro shocks. Like, if you see interest rates go up again by 5%, there's going to be another shock and another period of adjustment, and so forth. So as long as we have inflation under control generally in the Western markets, as long as unemployment doesn't like go through the roof and cause a crisis, as long as there's no like geopolitical disruptive events which disrupt like prices of oil by a factor of 2 or whatever, then I think things are on the road to stabilizing, and fundraising will get easier. But if those things happen, then it won't.
Totally makes sense. Okay, awesome. Thank you, Dennis, for just answering all these nuanced questions. So what we do is we have a decent big of an audience. So very fortunate to whoever listens to the podcast, read the newsletter, and like whatever we put on socials. What we do is we ask like everybody, hey, Dennis is coming tomorrow on the podcast. It's going to be around this. If there's any particular question you want to ask us, please let me know. And I get like all kind of questions, like all the crappiest one, all the good ones. So I'll try to ask you some decent ones. Okay, so there's like a few of them. All right, so in no particular order, in what scenario would you advise a company to opt for a venture growth debt over raising another equity round? That's the first one.
I think a company should raise a growth debt round if it can raise a growth debt round. I believe that any company should seek to optimize its capital structure, and having VCs and have reserves and reducing dilution for early investors is always a good thing. So there's a question of how much debt to take, and that's a question that each company needs to think about. It's probably a less kind of weighty question for an earlier company than a mature one, but if a company is in a position to take some debt, subject to that debt being on reasonable terms and on market terms, I think all companies that are able to do it should have some, because that's the optimal way to manage your cost of capital.
Okay, totally makes sense. How should founder balance the use of venture growth debt with equity financing to optimize their capital structure?
I mean, look, there's no like right answer to that. So like how much debt is the right amount?
Yeah.
I'll tell you how I think about it from my kind of selfish point of view, or not selfish, but from the point of view of a lender. Like, I'm concerned with capital preservation. I'm not concerned with like lending to own, and so my goal is not to like over leverage the company and then use that as a kind of a wedge to somehow take control of the business, right? So my view is to give the company debt, have the company be successful, repay the debt, and then maybe take more or whatever, right? From that point of view, I don't want it to be over leveraged. And how I think about it is, it's a percentage of, I would say, there's a few metrics. One is, you want to have a cash runway for at least the next 12 months, maybe 18 months. So I want to see the company should be able to service the debt for like the foreseeable future, which for startups is like 12 to 18 months, right? So you should look forward and say, like, I'll be able to service it for the next 12 to 18. The other thing is it's just the percentage of like the capital that's been raised to date. And so we really, and a percentage of the valuation of the business. So we come in alongside an equity round. So, to give you an example, if there's an equity round of 10 million and the pre-money valuation is 40, so post-money is 50, how much is the right amount of debt for the company to have that has a valuation of 50, right? And has just raised 10 million and maybe raised another 10 million before that in various other rounds. And the answer to that is probably like 5 million or something like that. It's like 10% of the value, 10 to 15, maybe 20% of the valuation, and sort of something like no more than 50% of the current round, and no more than maybe 30, 25 or so percent of the capital that's raised. So that's how I would triangulate it. It should be like a minority piece of your capital structure at this stage, not like a majority piece, which happens when you're like, an infrastructure business, earning $1 billion a year.
Totally makes sense. Okay. So where do you see the future of venture growth debt heading in the next few years? Are there any emerging trends you think like there's going to be somewhere around the horizon or something?
Interesting question. I may not be the best person to answer that because
you say something like AI is going to take over venture debt.
Yeah. Well, AI is gonna. I actually don't think it will.
Yeah.
I think AI might take over, other debt, because like all the work that a bank does to credit score a company can easily be replaced by like a Mark I IBM computer from the 70s. But anyway, that's a different story. Whereas with growth debt, there's quite a lot of like judgment and like a bespoke work that has to be done for each company. It's not a commodity, just yet. But I was going to say, I mean, look, I've been in venture debt much less than a lot of people that are in my position, right? So, I haven't had the benefit of kind of seeing the full history of the product, from its inception. I don't think it's as susceptible to automation as or commoditization as direct debt. So, like this sort of trend of automating and securitizing, as much as possible, it's probably not applicable to venture debt. Interesting question about, kind of trends. It's tough to say because, look, I think fundamentally in the first like 2 or 3 years of a company, like there's not that much like you can really like automate. It's not like AI is going to come and say, well, like starting a business is going to be, AI driven. You have to start a business like manually, right? And then at some point, like you put in AI to optimize this and that and that, like, and then you kind of do things like this. And we play at the end where it's still quite manual. And therefore we're still a fairly kind of, I wouldn't say manual, but we're still quite a judgment driven product. And so I think it's actually the least affected part of like the spectrum versus, everything else that is more standardized and easy to kind of put into a stencil and work with. So look, I think I don't foresee like massive shifts in either concept or how it's done. There's going to be swings and roundabouts about like good times and bad times, but I think fundamentally the product probably will have a place, for the next 10 years in a similar form to now.
Okay. Second last, what's the biggest lesson you have learned in your career regarding investment and all? Like, could be anything. Like, I don't want to limit it to just investment, but the biggest, like one biggest, you have to narrow it down to just one. What would that be?
What do I say without being completely cliche? If I look back, I learned the most in situations that have been the toughest. I've lived in different countries. I've done different business, different things. I wouldn't encourage people to drift. I think the lesson that I learned is like, don't be comfortable. Do something that's uncomfortable. whether it's move somewhere or do something different, because, it will ultimately add dimensions to your skill set and your kind of perspective that are, difficult for others to obtain. So don't drift, don't be comfortable, take things that are risky, make them work, be resilient. And if they don't work, it's okay. Like, I wouldn't recommend that people just focus on the promotion, next promotion, this and that, and becoming a title and all this sort of stuff. Like, it's not about that. The career is a winding path.
Makes sense. That's a good one. Okay. The last one is, which is kind of my favorite as well. What's your best and worst investments to the date?
Best and worst. I'm not going to talk about the fund. I'll talk about personal stuff. My best investment. Okay, if I want to be really honest, I'll say it's family, but it's not a financial answer. So I understand that people are not looking for that, right? But that's the best investment you'll ever make. Family and kids.
It's like starting a family?
Yeah, well, starting a family, having a family, investing time, I guess, in your family, in your marriage, whatever. Like that's like, don't underestimate that. But financially, look, like my best investments have been, when COVID happened, I went and bought everything that wasn't nailed down, basically, right? And so I put in, I was quite liquid at the time. And so I bought everything from, Amazon to Microsoft to Airbus, and all those things are like plus 200% since then. So to me, that was like a no-brainer, in a way. I mean, I missed out on NVIDIA because I thought it was already kind of overvalued. It ended up
okay.
another 20 times.
Okay.
So,
yeah.
And the worst investment was I got on to this to an NFT fad, and I invested in a small company that was going to. It was actually not started, but supported by somebody I knew and a friend of mine. And so I thought, if nothing else, I'll learn about NFTs. And so I invested in this NFT business, which went under in under a year. So that was.
Do you still own any of those NFTs?
They weren't NFTs. It was an NFT platform, right? It was like the thing that would facilitate like a brand to create NFTs. Like, you'd sort of go to Nike and you'd say, well, use our platform to create Nike NFTs. But then after the whole like fad ended, like nobody cared about that anymore. And so this NFT platform, ran out of cash and closed. So I lost all that money in the year.
I know. I am kind of a victim of crypto NFT myself, so I can totally relate to that. Dennis, we do have this one small ritual on the podcast. So what we do is we ask all guests a question for the next guest without telling who the next guest is going to be. So the previous guest left a question for you, which I'm going to ask you. And then I'm obviously going to take a question from you for the next guest. Okay, but it's not going to be it's not going to be part of the recording. The question that the last guest left for you is, what is it that is coming up this year that you're very interested and excited about?
I can't tell you that yet. I mean, there's a specific thing that's coming up, but I'm not at liberty to say what it is.
Let's say global trend or something like that. Let's talk about that. Maybe not something business related. I think everything has an answer these days, and the answer is AI. But I'll let you pick one.
No, I refuse to talk about AI and say AI. Look, there are a lot of interesting things happening this year. I guess I look forward to kind of just less bloody war in the world. I think war is bad for business. So this year, I'm looking forward to at least some of these wars kind of coming to an end. I don't have a stick in the sand. I'm not going to get political, but I just want people to like stop having the bloody egos, and just resolve things and move on.
Thank you so much, Dennis. Thank you so much for the time. I really appreciate it. Appreciate talking to you, and thank you for all the wisdom, candor, knowledge. It means a lot to me.
It's been fun, man. Hopefully we can do it again. And thanks for having me.
Absolutely. Yeah, absolutely. This is it from today's episode. I hope you enjoyed it. Thank you so much for watching and listening. All the resources and links that we have talked about, they're all in the description or in the show notes, depending upon which platform you're on. If you're listening on Apple Podcasts, please give us a review. Would appreciate it. If you're watching it on YouTube, please mention down in the comment, did you like it? Did you not like it? What do you want us to improve? Who do you want us to invite on the channel? If you enjoyed this episode, there are chances you're going to enjoy that episode as well. So we're going to link it down somewhere here. Do hit the subscribe button if you haven't done that already. And thank you so much for watching again. And I'll talk to you soon. See you in the next one. Peace.